Eddie's got some gothic music going today. Happy Sunday, everybody. I hope everybody's having a fantastic day. I just want to put in there the housing market has shifted, but not in the way that some people and experts have predicted. We have a 28% more interest in mortgages in the last few weeks. So I wrote some notes. So I'm going to read them aloud. So customers are returning to the holiday season with mortgage rates at their lowest point since September. And the responding is dramatic. Mortgage application volume jumped nearly 28% last week compared to the previous week, according to the Mortgage Bankers Associational seasonally adjusted index. The refinance demand made the biggest move, up at 34% from the previous week, but it was still 81% lower than the same week a year ago, to be expected. Applications for mortgages to purchase a home rose 25% week to week, but were still 35% lower than the same week a year ago. Not surprising with that either. The inventory, the market, however, is not seeing a surge in inventory. That is still down. The number of active listings is about 21% higher than it was a year ago, but the prices still continue to tick up, but not nearly as drastic as a year ago. And in order to break this all down when it comes to mortgage rates and what's going on in the Fed, the best person to have this conversation with is my good friend, Mr. Ryan Larussa from GMFS Lending.
What's up, y'all? I'm glad to be back, man. It's Happy New Year to everybody. What? It's hard to believe it's already 22 days into the new year. Goodness gracious.
Yep, and mortgage applications are now up 28%. What is the scoop on this? Are you seeing a lot more mortgage applications in the past week?
We have. I mean, the last 3 weeks, I guess. Kind of going back over the month. I mean, January 4th or 5th, it was kind of like everybody decided to really wake up, and things have been just crazy. I mean, my phone literally, I was Friday coming home, 5:30 on the phone, 7 o'clock Friday night on the phone, application yesterday on the phone. Today, I just jumped off a call a few minutes ago. Lots of first-time home buyers back in the market, Kristina. Lots of that. So I guess if I don't know to take a gauge, but I could definitely feel, I think you said 25 to 30% increase. Yes, I definitely feel that application wise. The last 2 weeks have been super, super busy. So it's good. It's good.
Do you think because there is so much more interest with those first-time home buyers that the prices for homes that would be in that first-time sector are going to go up? Are we going to see bidding wars? I mean, what is this going to look like for a first-time home buyer right now?
Yeah, that's a great point. I tell you one of the things that I've seen here, and I know good, bad, or indifferent. I'm just speaking from the local market. But I do business nationally as well. But let's drill it down in Baton Rouge first and surrounding areas. You know, you still have your track builders, your D.R. Horton, DSLD, those guys offering wild incentives. Like D.R. Horton right now is $18,000. They don't care if they use me, Joe Blow lender, it doesn't matter. But giving $18,000 to either buy down the rate, pay closing costs, a combination of both, use incentive package. I've got a custom builder that gave $28,000 off on a $500,000 house. But I mean, the D.R. Horton stuff, I mean, those price points are, $200,000 to $300,000, and given that kind of incentive, I think has really sparked a lot of people's attention, whether you like them or dislike them. I'm not saying anything good or bad about D.R. Horton, but DSLD, and Level, all these guys, Level Homes, a lot of these guys giving massive incentives, and I think it's really starting to kind of resonate with the buyers.
Do you think that they're in a panic mode, and that's why they're giving those incentives? Do you think it's because they're trying to shoo people away from buying an already existing home, or what is their motivation to give such a large sum of money when there is so much pent up demand for the first time home buyer.
Well, I think what you see is let's go back to October real quickly. Okay. So October 2022, rates were mid sevens, right?
Right.
And so you had a lot of people pretty much put the brakes on because of fear. I had many people tell me rates are going to 9, 10, 11%, just going crazy. That was kind of the peak. And so then you tuple in November, December, holiday seasons are typically always kind of slow to begin with. I think a lot of this coming out of the gate in this brand new year, really flashing a lot of this. I don't really think that they're in this major fear mode, but I do think it's a motivation to get people back in the game, and it's working. I can tell you that due to the applications that we've taken. But I mean, you go from October mid sevens down to now upper fives, right around 6%. That's a drastic change. And that's a drastic change in somebody's monthly obligation or payment. And those people, again, what we've been saying for so long, first time home buyers, they want to buy, but more importantly, they have to buy. The person buying that $400,000 to $600,000 house doesn't have to do that. And I know that they I was reading some stats over the last couple of weeks about how much the average home has increased in value, and that's fine and dandy. But again, I've seen it, and this has been this way for a long period of time. That first time home buyer is not so much concerned with the rate as they are the payment.
The payment.
The payment's very important. So what's the payment? Does it make sense? And if they're offering those type of incentives, and you could buy the rate down a couple percentage points, so now you go from whatever, just call it 6% to 4%. Well, that's an amazing deal on their payment. So they're all about that. So that's kind of what we've been seeing. I wouldn't say fear. I just think it's that time. And I really believe, I'm going to call it here, but this is some information that I've been given, is that May the 10th of this year, you're going to see some amazing news come out on the inflation front. And you're going to see rates really tumble back down. They're not going to where they were, people, but it's going to be, I think it's going to be low fives, 5.25, 5.375. And so I think everybody's starting to kind of realize that. What's that going to do for the demand? I mean, we already have massive demand. That's going to make the demand even hotter. So I think the people that were sitting on the sidelines the last couple of months are like, all right, this is what it is. I'm going to get in. I'm going to make it happen.
So like if you're the first time home buyer, you're probably going to have more of an advantage with some of these builders than you probably would with a resale seller. Do you believe?
I don't believe that, because I have seen a lot of these sellers now paying even on these 200 to 2. I got one this weekend. I got a purchase agreement in yesterday afternoon. 245 purchase price. Seller was paying $7,000 in closing costs. This is an existing house. And I've been seeing that for quite some time now. So I don't believe that to be the case. I just think it's that kind of perfect storm to where you have sellers kind of understanding, okay, here's where the market is. You got these builders that have built up a lot and they're continuing to build, but they just can't maintain with the pace of the amount of demand due to a lot of, not many starts, right? They haven't had a whole lot of new development, new starts going on in the grand scheme of things. So that's what I believe's really pushing it. But sellers of existing homes and obviously builders are both now paying closing costs.
Right. Yeah. It's been an interesting time. I'm still like, when it comes to the lower price point for that first time home, it just doesn't seem like we have enough for the amount of demand that I think is going to happen when you start seeing houses interest rates go into the lower fives, because people will be like that, if we were on the fence, now this is the time, because they don't know when it's ever going to go down again. And so I think my fear is those people that are just trying to get into that first home. It makes me nervous for them. There was a CNBC article, or MSNBC. Which one was it, Eddie? I think it's MSNBC. They were talking about the demand and what we should be expecting. and they were talking about home affordability as being one of the biggest problems. Here, it's mortgage demand jumps 28% in the week as interest rates drop to the lowest point in months. So when do you think we're going to see the demand? I mean, the interest rates in the lower fives?
I think that's going to be April, May. I don't think we see anything before that. And, the interesting thing too, right now that you find is when you call your bank, I've got a lot of people that we talk weekly and just kind of keeping myself up to breast on what's going on. I mean, the banks are 7.5% and 8%. That's where they're telling their clients that the rates are. Mm-hmm. Another huge piece of news that came out in the last week was Wells Fargo stepping away from the entire space of origination on new business, right? So they've been in a mess for a while. I know it's been all over the headlines about them doing all kinds of different things, opening up checking accounts and different folks' names and charging too much in fees. Well, they've pretty much just put the whole entire pause on origination. So they're done from that standpoint, which really doesn't affect us, myself, in any way. But I think it does give light to some of the things that was going on in the industry. I don't know. I kind of go back and forth. Does that give the consumer confidence or not? I'm not sure. But it's obviously just based upon the last couple of weeks, builder sentiment is up. And I think when that happens, that's good for all of us. We got to have the builders have that feel that the clients are there. And I think we're going to see things kind of settle out this year. I don't think we're going to see these major swings up nor down in interest. And I know for myself and for a lot of investors that I talk to, they just want things just know where the playing field is, because it's been all over the place. I mean, a year ago, rates were 3.5, 3.625. Now, they went from 3.5 to 7.5, and people just can't handle that. I know we talked about that the last time I was on here. People just put the pause button on it.
Well, and then that was like the catalyst for a lot of people saying that the housing market was going to crash. But there's so many people that have those lower interest rates. And if the only people that are going to sell when the interest rates are high like that are people that have to sell. So a good portion of the inventory where people thought it was going to flood the market, they're going to have to take a bath on there. And they're like, no, I'm not taking a bath on my house. I'm not going to pay that much more to go into a new house. So I'm just going to take my house off the market. We had a lot of those that happened. Like it was just like overnight, people were withdrawing their houses quickly. But the housing markets always move no matter what the market is. In the lowest markets, in the highest markets, there's always houses that are being sold and it still moves no matter what. But I just don't see that in the next 6 months that housing prices are going to drop drastically. I keep getting all these messages on my on my videos and these live streams that, you're wrong. It's going to crash. When are you going to admit it? It's crashing. The housing market's crashing. And I'm like, but the data does not say that it's crashing. We still don't even have enough supply of homes that would consider it a fair market.
Right.
We don't even have over 6 months supply of homes across the country that would consider it a fair market. Now, there are some housing markets that are seeing more of an effect like people are hoping for. San Francisco is one of them, Austin, Texas, Phoenix, Arizona, even Las Vegas. Yes, they're seeing more of a correction than the majority of the United States. But if you only look at that microcosm and you say that's what the whole housing market is, that's not how the whole housing market is. So just be aware of that, especially if you're in the market to buy a house and everybody's like, oh, the market's crashing. Look what's happening in Phoenix. And you happen to live in, Atlanta. Don't even look at that. You have to look at your specific market itself.
Yeah. And I think the big thing that you got to realize is that when you go back and just use just talking about Phoenix, Vegas, Dallas, those markets saw a 30 to 45% increase over the last 2 to 3 years. Okay?
Correct.
So you couple that with low rates, the amount of equity that those folks are sitting on is crazy. And you and I kind of touched on it the last time I was here. Let's say that it corrects in half. Okay. In half, which is drastic. And I don't at all see that to happen, but they're still in an amazing. So if I went from 40 to 20% gain, I don't like it, but I still love the number that I'm going to walk away with if I got into a financial bind. I mean, that's just the reality. And I don't wish it. I don't speak it. I just speak the truth of knowing what I've seen over the last 22 years. We're not anywhere close based upon the economic factors that are out there. I do believe, the good feds that we all talk about, they're gonna continue to bump the federal funding rate, which again, the people that I speak to day to day do correlate that with mortgage rates, even though that's totally inaccurate. Mortgage rates are based upon the 10-year Treasury bill. And if you watch what the 10-year Treasury bill has been doing, it's been falling quite a bit, because every time they've raised the federal funding rate, helps fight inflation. The 10-year Treasury likes that, which lowers mortgage rates. Again, just kind of looking at some factors. Now, specific to, I think that you will see some inventory hopefully loosen up like this. But again, I think that this is important to know. I'm going to use myself as a personal example. This is a real life example. So I bought several properties 5 years ago with a local bank. I got a commercial loan. Okay. That rate was 4.5%. It was on a 5-year fixed 20-year AM. I just got the renewal on that. That rate went from 4 to 7.875. So myself, even though I do not like that payment, I'm in amazing equity position. So I got a decision to make. I'm going to go to my tenants, raise rate, or am I going to say, you know what? I'm just going to take my gains, sell those pieces of property, roll that into 1031, roll that into something else, and move on.
What are you doing?
I have options there. Most people, when you think of it that way, that gives inventory, which helps the folks that you're talking about, which I like that. If I hold on to it, I'm not going to lose, because at some point I am going to be able to increase those rents a little bit. So there's always some things that are going to move the market. But as far as this dramatic crash, no, I bought it 5 years ago at a phenomenal price. I've made X along the way. Here's my option. And so there's always the folks out there that love the hype of, okay, well, you're wrong. Here's where it's going to be. It's a different animal. It just really is.
Well, we've been seeing a lot more like major layoffs in areas, and I've heard people even in the smaller groups of companies, not the big players like Amazon, that there's going to be more layoffs. Do you think that's going to affect home prices, and do you see that being a problem or a good thing for people that are trying to find a more affordable home? Do you think this is going to be something that affects the housing market, and how long would that take if it did?
Yeah, I think it will. I think it's going to affect it some, but again, big picture, back away. We always zone in, like you do such a great job of this, not tooting your own horn, but I'm just being honest, is that we can say, how would Amazon's layoff, because when you turn the news on, 18,000 layoffs, oh my gosh, how would Amazon's layoffs affect Baton Rouge, Louisiana?
Right.
Zero. That's the true answer. Now, different markets, will it affect it? Sure. I have a client right now. We've been working together, and he's got a pretty decent job in the plants, and he lost his job and some layoffs, but he can go find another job tomorrow, because if I talk to a lot of the employers that I know, they're like, man, we're starving for talent. We're starving to hire people. So there's tons of jobs and tons of opportunity out there. I don't see that causing a major problem. In some markets, yes, it would. If you went to, let's go Fayetteville, where you got Walmart and you got Hunt's and a couple Tyson. If those companies had major layoffs, would that affect the Fayetteville market? Sure, I think it would. But I think you just got to be real careful when we hear these massive layoffs, these massive things that are happening. It's going to affect it some, but it's not going to have like this dramatic 08 feel to where, everybody's in this major panic. I just don't see that.
When like a market is controlled by one industry. Like if you live in an area that's only like they just do nothing but oil, right? And then oil goes crazy, then that housing market is drastically affected. I mean,
Correct.
Detroit, Michigan, the car business was what drove that whole entire city. And once the car business left, then they've had issues ever since. So I see what you're saying there. Dinky Shop says, if people are paying more than 30 to 45% of their income on housing, it's at crisis level. And you are correct. I have been saying this for the last, 2.5 years, because people have been paying so much more for housing, more than they ever have in history. And the people that I truly feel for are people that are renting, because they have no choice and their options are so limited. It's like, it actually makes me very nervous. I talk to Eddie about this all the time, because I'm like, I think we're going to be okay when it comes to houses for rent, but I'm afraid that's all they're going to be in the future, like in the distant future. And every time I say distant future, then all of a sudden it ends up being a lot sooner than I thought. Time seems to fly a lot faster when you get older. The corporate investor and how much have invested in the last 2 years is, it's obvious at this point. They kept blowing it off, and now it's obvious how much they have taken over. Matter of fact, Tuesday's video is talking about how many homes they've bought and how much they kind of they'll say they only bought X amount of homes, but they've been saying that same number for the last 3.5 years, actually since 2017. So it's been even longer than that. And we all know that they own a lot more homes than that. So I don't know. It makes me nervous for my kids. Linda Kingsley says, some are stating that the new home builders are coming online with corporate cash buyers want to get in and clean up cheap. At Davos, Switzerland, the billionaires are talking recession. Okay. So and this is true, in some areas around Phoenix, Arizona, and even Austin, Texas, builders panicked. They decided to get into the multi-unit sector because we have a lack of rentals. So some home builders quit making single-family homes, and they sold the rest of their stock off, or home stock, meaning housing supply that they had, gave it to a corporate investor. They made them a deal. They said, you write us a check, these houses are yours. And then they went into the multi-sector. So that's why I think that rents should be coming down in those areas shortly, once those houses once those apartments are completed. But I don't know how, so there's talking recession. Do you think that if there is a recession, like some experts are saying, that's going to affect interest rates and home prices drastically to the point where people would lose 40 to 50%, Ryan?
Well, I think anybody that's been living, breathing, and actually soaking up oxygen, if you don't believe that we've been in a recession for the last year and a half, then you're really not following the economic factors that prove that we're in a recession. Right. We've been in a recession. And so the worst, I tell this to folks because, again, I'm just in this deal every day and I've seen it. I kind of back away and I talk to people all across the country. What we've been in has been a full-blown recession, and the worst is behind us. And I do believe that this year you're going to see, again, circle the date on your calendar, May the 10th. You're going to see some unbelievable data come out that's going to just line up perfectly of where we are. We got a Fed meeting in February. We got one in March. We got another one in April. At those three meetings, I think all of those three, you'll see some bump up in the federal funding rate, which will help inflation, which is going to lower mortgage rates. So no, I do not believe that you're going to see this recession that people are waiting to, okay, if they called it tomorrow, excellent, fantastic. I think that would speed up where we're already headed. So I think all that's behind us. Now, that's speaking to mortgage rates. And look, we're all consumers. We all understand that everything we've been doing is costing more. Going out to eat costs more. Gas costs more. Anything you do costs more. We're full blown inflation, recession. That's where we are. if I told you that I would think it would not affect home prices, I really believe that it's going to affect them some. And when I mean some, I think you're probably going to be kind of flat this year from an appreciation standpoint. And this is just Ryan's prediction. But I mean, we got to understand we're up 30 to 45%. That is unheard of
Mm-hmm.
over the last 3 to 5 years. And then if you went back even further than that, rates have been substantially low for such a long period of time. I mean, you go back even at that 4.75 to 5% before the pandemic, think about the amount of equity that people have built up. That is a fantastic rate. 21 years ago in this business right here, it was an 8% rate. That's what it was. It didn't matter if you were 800 credit score, putting 20% down, 8% was the rate.
I do want to say I had started a poll at the beginning of the stream, and it said, will housing prices continue to go up this quarter? And the majority said they would remain flat. They're with you. The majority, 41% said it would remain flat. The other 36% said yes, unfortunately. And somebody said, no way, they're going down. And then I said, it's going to collapse epically. Only 8% said that. Oh, Johnny O with the $100 super chat. Thank you so much, my friend. Every week they come in for the last 3 weeks and have given a $100 super chat, and I appreciate it. That helps support the stream and puts food on the table. I appreciate that very much.
Thanks, Johnny.
All right. Bubble Nugget says, question, how could they all know what the income would be for the actual return, extra expenses for extra cocoa tax, loco tax, for all local buildings near the tax return falling TTS? I don't understand the question. I don't understand the question. Could you rephrase that and put it back in the chat? I'm not really sure what the question is. Oregon prices are still ridiculous, about 100 to 150,000 overpriced from a year ago. Here in our area, they're definitely not going up like they used to, but they've remained flat. But at least sellers are more willing to work with buyers, because there for a hot minute, some of these sellers were getting pretty greedy. Don't blame them; they're playing the market. But I like it better. It's a lot less anxiety when the two parties can agree on something. Like when they're willing to work together. Like, we'll do this if you get this done, like they could at least have their inspection request looked at and some of the repairs made, there for a hot minute. They're like, you can do an inspection, but we're not fixing anything. It's like, what? Some of these sellers are crazy. So I'm thankful that at least the buyers have a little bit more leverage in their hands right now. And hopefully that will continue even as the interest rates can continue to go down a bit for hopefully for the rest of this quarter.
Right, another thing I think we gotta mention this, because this is super important, right? Just to kind of talk through this. And when you think about it, you take the emotion out of it, but you think about it this way. You had people buying houses, and I know you and I off this call have talked about this multiple times. You had people paying 20 and 30 and 40,000 more in price, but here's the difference over the last couple of years. So purchase price, let's just use numbers, 300. Chantel and Ryan really wanted that house, so we may have bought it for 325 or 330. But the difference this time versus 07, 08 was we were bridging the gap based upon money that we had already, putting that money down. So I was buying the same house. Okay. 300 was the purchase price. Ryan paid an extra 25 or 30 out of his pocket, but the mortgage company said, hey, the purchase price is still 300. You got to bring 5 or 10%. So yeah, I may have overpaid, but in my justification was the lower rate. And I really liked the house because we really fell in love with it. We could debate whether I made a good choice or a bad choice and all this, that, and the other. But the story still remains. I've continued to get appreciation. I bridged the gap on the difference. So I'm still sitting on a ton of equity. That's what people are not understanding okay, well, you're just completely wrong. That happened so many times, guys, in the last several years that I can't even count. And it wasn't money that was financed in the deal. It was money that they had that they paid down payment. Debate right or wrong, bad financial move. You paid $30,000 too much. If I got in a bind, I could still sell that house, make my money, and move on. And so that's the big thing. I think we all got to. I don't like where we are. I'll be honest. I love helping first-time home buyers. I help a ton of first-time home buyers. Okay. But that's just where we are. Great news. The first-time home buyer is actually now having an opportunity to buy a house. Even though the price is higher, they're getting closing costs. They're able to do a rural development loan. They're able to use some bond money that we offer. There's a lot of things out there that the last 3 years, they did not have a chance because the investors and folks that had different types of financing, i.e. conventional loan or even an FHA loan, there was no such thing as 100% loan. There was, but you weren't getting them approved because they would laugh you out when you tried to make an offer with a rural development or a bond money program. It was
even
like,
VA.
You're
even
out.
VA.
Even
they
VA.
Like,
nope, not doing it. So, I mean, that's the factors that we face. And again, I think you got to understand too. I ran these numbers for a client Friday night. We were talking about, okay, what offer should I do? Should I put 20% down or should I put 10% down? We went back and forth, and we just did a calculation. Now, this was a larger loan. It's not my typical loan size. My typical loan size is around 250 to 265. But on a $480,000 deal, which this was, 1% difference in rate was over $300 difference in payment. Okay. So
that's a lot of money to people.
That's a lot of money, $300 difference. So he's opting for using what the seller is paying to buy his rate down 2 points. So instead of 6, he's now going to 4. Okay. So he's saving. When you look at it, he's not paying anything. The seller's buying the guy's rate down 2 points on this deal. That's a $600 difference in payment. $600. So do you think he's not going to do the deal? He's absolutely going to do the deal.
Right.
You know, so those type of things. And again, if it's me, I'd love to help you and talk about it, but get with somebody that understands, that can look at it from a very unemotional standpoint. And when we started talking numbers that way, he was like, dude, I'm going to put less money down. I'm going to put 10% versus 20%.
Cash.
Yeah, I'm going to hold on to my cash. I'm going to let the seller pay the points down 2 full percentage points, and I'm moving forward that. And I'm going to even if the appreciation's flat this year, he's saving $600 a month versus where he would be paying the normal payment. So that's happening probably every other deal. I think we closed 22 deals last month, and I guarantee you I probably had 9 of the true 2-1 buy down, meaning the rate was 6. I bought it to 4 with the seller's concessions. People love it. So,
we're going to get to this question really quick, but don't let me forget. I want to ask you about that new FHA loan package that's available. I don't know anything about it, so I'm hoping that you can enlighten us a little bit. Okay. But YouTube Car Spotters Guide has a question and says, are loans assumable? Some of us have a 2.95 with a 28 years left, and Pace Morby has a subject to offers taking over existing mortgages. Do you know anything about the assumable loans?
I do. The assumable loan has to go back through the service provider. So if Wells Fargo is the mortgage provider, you got to go back to Wells Fargo to get the assumable loan done. Not every single loan is assumable. A lot of your government-backed loans are, i.e. FHA and VA. A lot of your conventional loans, Fannie Mae, Freddie Mac, are not. If the loan's with GMFS, the company I work for, then you got to go back to GMFS for the assumable loan to work. But definitely a good thing to bring up. Here's one thing I can tell you that really most of the time makes an assumable loan not work. And that is, if the person bought the house 5 years ago, let's call it for $250,000, and today they're trying to sell it for $300,000, you have to bring, or the buyer has to bring the difference. Well,
$50,000.
I don't have 50 grand, Ryan. If I did,
Right.
I wouldn't need you, right? So that's why a lot of times it doesn't make sense. Even though the rate was at whatever she said was 2.8 or 3%, if the rate today's 5.8, so the rate goes up 3 points on a $250,000 loan, but I could finance $50,000 less, I'm gonna go the higher rate and then maybe get the seller to buy my rate down a couple points to get me where I need to be. So that happens quite a bit right now, even though the assumable loan has brought a lot of conversation and topic. When you start thinking about it that way, it's very difficult to make it work. It does work if somebody's in a financial bind. They maybe just bought it a year ago. They're going through a divorce, something like that, even a year and a half ago, something, maybe the rate was lower. That's where an assumable loan would really come into play.
Yeah, I just think that people are trying to find more creative financing ways to get a house, and it does come up a lot. So there was a product that was brought up. I ended up scrolling on TikTok, you know how you do, and I was scrolling on TikTok, and this guy was talking about 100% financing VHA. Oh my gosh, FHA loan.
I like it.
FHA loan. Is this a product that you know about or heard about, or was that just a TikTok thing?
No, well, so there's a lot of products and programs out there. So, and I'll speak to this. I don't want to bore the audience because of people, like, oh man, I don't really like to talk about programs a lot. I like to talk about getting with a professional real estate agent that knows the market. I like to talk about getting with a professional mortgage guy that knows what products are out there. But let's speak to this product situation real quick. Yes, there are FHA loans. Yes, there are conventional loans to where we can add in a down payment assistance rider. Okay. In Louisiana, it's called LHC, Louisiana Housing Corporation, to where you can absolutely finance 100% using an FHA or a conventional loan. And that's probably what he was speaking to right there. Okay. But a true FHA loan, you got to put your 3.5% down. The buyer does. But that money could be from, if you have decent enough credit, you could get a gift from your mother, your brother, your father, your sister, your uncle, your employer, and you could still buy a house that way. I wasn't that blessed when I bought my first home, but it is an option. I understand that sometimes people have the family members that want to step in. But going back to that, is it available? 100% yes. And you are seeing here's the point on that. Several years ago, they would laugh you out of the building. They meaning the sellers. Not happening. I'm not accepting that. Now it's a whole different market. They're like, yeah, okay, well, let's see if we can get this done. If we can still close within 30 days, I'm in. And that's the other beauty of kind of where we are. I mean, loans are being able to be closed in a couple weeks. 3 to 4 weeks is very common in this market.
And no matter what state you're in, they always have some kind of something that comes up within the state to help first-time home buyers. They'll have they'll have a first-time home buyers plan. Sometimes they have something called bond money. Sometimes they'll have credits, something you could do as a first-time home buyer in that specific state. So it's important for you to work with a lender that's in that specific state, because they'll know what those programs are that are available. A lot of times when you work with the big national brands, they have no idea that there's bond money out there. They're just writing loans for everybody. They're doing it from Arkansas to Massachusetts. They don't know. So yeah, that's
a great point. So I don't want to forget. And I'm not knocking banks. I'm just telling you, this is how the market is right now. Banks do not like to offer these type of scenarios. They're very black and white. They want your car loans. They want your CDs. They want those because that's a lot easier transaction for them. The mortgages, they broker those out to somebody like us. So you might have heard about rural development. Guess what? The bank is not going to do a rural development loan. It's not going to happen. You may have heard about bond money. Guess what? The bank is not going to do that. So banks have really separated themselves more than ever over the last probably 3 to 5 years from mortgages, because they do not want to operate in that space. We saw Capital One get completely out of the mortgage business in Louisiana. I just mentioned Wells Fargo. Why are they getting out? Because they want the other type of business it's very small margins and it's not worth the risk. So you need to get with someone that's local or a direct lender. There's a big difference between a broker and a lender. You want to get with someone that has a wide variety of products and programs. I talk to people every day that talk to, I'm not knocking them, but it's just reality. You go to D.R. Horton, they want you to use DHI Title. They want you to use their mortgage company. Well, their mortgage company is not well versed because they build homes. They're not a mortgage company. Now they want you to do it all together, but there are a lot of other great opportunities and a lot of other great companies that you could go to pick up better products and programs that's going to help that first time home buyer. That's going to help that person that didn't even know what we just talked about.
Super chat with CC Moon, $4.99. If I want to buy a second property, make it my primary home, is it better to get an equity loan or save X percentage to get a new mortgage? Pros and cons. What is your opinion there?
Oh, I love that. I love that question. I would ask first, do you have a home that you're living in that you're maybe looking to upgrade? So this is what happens for a lot of folks that I advise. Hey, they may have bought a house 3 or 5 years ago. It could have just been me before I got married. Okay, I bought a house. Well, I'm going to keep that house and I'm going to rent that house out. And then my wife and I are going to buy a new house and it's upgrading. So we're going to put a very minimal amount of money down, 3 to 5%. I'm a big component of holding onto your cash and letting the equity work for you. Okay. And I was able to do that and understand that I understand the risk. Now, I'm not saying be reckless. I think there's a big difference here. I'm not being reckless, but I'm calculating the appreciation. So I would keep the house. I would buy a new house with a very minimal money down, maybe 5 to 10%. And then I've got 2 pieces of property and I've got the other property that I kept. It's not only paying the note on that house and paying down that equity position, but the profits, I'm able to bank that and maybe even use some of that to pay my new note. So I think that's a perfect, it went away, but I think that's a perfect question. And I think it's a great opportunity to build wealth for yourself and your family. I have a lot of property. I love the question like that. I think the creative juices and being able to look at that as an opportunity to build wealth for you and your family is a very strong avenue, not counting all the write-offs and different things that you have. Great question. I love that question. Thank you.
I will say this too. All the billionaires in the world, guess what they have a lot of?
A lot of real estate.
A lot of real estate. A lot of real estate. Eddie Royal says, question, with the start of the tech layoff, i.e. Microsoft, Amazon, Google, do you think the housing market is going down because of the layoffs in Dallas, Austin, Houston, Texas? Those areas were already being affected before there was any layoffs. Dallas hasn't seen as much of a hit as like Austin or even Houston for that matter. But like Ryan said something very, like, if you think about it, when you hear, oh, Amazon is having massive layoffs and you hear 18,000, Amazon company, the company itself is all over the country. If you take $18,000 out of the 18,000 workers out of the workforce across the country, that's like a speck of dust in the wind. Nobody's going to feel the effect of that unless it was 18,000 jobs in a specific area, right? That would be like one town, one area, one county. That would affect a lot of people and you'd feel that impact instantly. But 18,000 jobs across the country is not going to affect, in my opinion, a housing market. But if we continue to see those types of layoffs in all sectors, not just the tech, then yeah, of course we're going to see it. But who knows how long that will take before it affects the housing market itself? Because like Ryan said, there is a lot of equity in people's homes, and it's going to take a lot of time to eat away that equity before they would, need to short sale or foreclose or any of that.
Here's the point that I bring up too, that I think that most of us don't. We read the headlines. The headlines are what sells. They don't talk about what price point or what salary or what hourly rate wage those layoffs were affecting, right? They don't talk anything about that. They just put the large number out there, which scares us all, including myself. Like, golly, seems like that's massive. but those people are not going out of the workforce. Those folks are going to find another job. If you got, most of those people are just going laterally, like a lot of these plants around where we live, chemical plants and plants like that. If they get laid off at Shell Geismar, they just go to Exxon. If they get laid off at Exxon, then they just bounce to the next place. If somebody loses their job for, say, with performance, they just go to another Brock or ISC. So, you know, I think that the headline is, oh my goodness, they're losing their jobs, they're out of the work. No, they're not out of the workforce. They're going to go find another job. But I think going back to that specific market, I was reading an article this week talking about the 10 best places in the South to buy. And I thought this was interesting. It had Atlanta number one, and then it shows out to the side the average median price, $370,000. Number two was North Carolina at $460,000. Number three was Dallas at $400,000. I mean, you start thinking about those price points. Again, I've been doing this for a long time and look at income every single day. You got to have a total household pretty strong to be able to support those numbers long term. Okay. But I do realize, and I want every one of us to realize, that when you factor in a 30 to 40% increase of appreciation, they can take a pretty substantial hit to equity. And even if they're cut in half, they're still really good, y'all. That's kind of the takeaway that I want to make sure that we all follow up. And you don't know how much money that they put down when they bought those houses. There was a lot of money floating around over the last 3 to 4 years. I saw more people put more money down on houses than I've ever seen in my 22-year career. The other thing that I'm hearing a lot of now is you had people that bought houses sight unseen. They're not happy of the decision that they made. So I think that's going to be a regeneration of new equity that's going to come available because they made a quick decision based upon interest rate. They didn't really do their due diligence like we're seeing now. I mean, now, guess what? They're checking it all out. They're getting the home inspected, and the seller's even willing to pay some of the, hey, this come up on the inspection report. Now I'm willing to pay some of this because they want to move that piece of property, not out of freakishness or fear, but I mean, homes are still selling within inside 30 days. If it's priced right, within inside 30 days, that house is selling. So you got to look at all the different factors. That specific question, I love it. But I don't think you're going to see in those markets this drastic hit because you do have a lot of different variations of income coming in. I hope that answered your question.
Prior to the pandemonium, like where everybody was going crazy buying houses, the average day on the market was 45 to 65 days on the market. If you were to have that, and that was normal, that was a normal, steady market.
Right.
Sellers, buyers, you know, it wasn't like the buyers were raking over the sellers and the sellers weren't raking over the buyers. And that's how long homes stay on the market now. Average days on the market is still like 30, 35 days on the market. There's still a lot of activity going on in the housing market because it doesn't look like it did last year. Does not mean that we're having a housing catastrophe at this moment. Because before the pandemic, when people weren't even paying attention to the housing market, 45 to 65 days was pretty normal, pretty normal to have a house on the market. Jerry Prusa has a question, says, question kind of dumb. There is no dumb questions. What is the purpose of points? To confuse the transaction, maybe? Why? And then they followed up and said, why isn't it? What do you want for the house? Okay, I'll pay that. Then let it be simple. They want it to be simple.
Okay. So let's talk to the first question or first part of the question real quick. I think it's important to know, what is a point anyway? Like I know it confused me the first time I ever heard about like, what's a point? What does that mean? So basically today, let's say today is Monday. It's not, but let's say tomorrow rates open up and the interest rate on the 30-year mortgage is at 6%, just to make numbers easy. Okay. The buyer can spend 1 point or 1% of the loan amount. So on a $200,000 loan, it would cost him $2,000 to lower the interest rate about 0.5%. So you pay 1 point and it affects your interest rate about 0.5%. It should not confuse you. Now, do I think it's not really explained well sometimes or most of the time? Yes.
Okay.
But that's just to help lower the overall interest rate, which people said, well, why would I do that? Well, then you just do the math and say, okay, well, if I got 0.5% lower and I saved 100 and just call it $100 a month times 12 months, that's $1,200 a year. So I break even in the first 2 years. Well, if I'm going to stay in the house for 5 to 7 years, pay the 1 point, get 0.5% lower interest, rock and roll with it. The other thing that can happen too is the buyer could pay the 1 point, which is 0.5% in rate. So I go from 6 to 5.5. And then if I wanted the seller to buy my rate down 2 points by paying closing costs or concessions, then you could go from 5.5 to 3.5. Wow, that's a huge win, right? So that's what the point system really comes into play. It hadn't really been something that was a big deal in the last couple of years because rates were already so low.
Right.
But now that is back into play, and we've been seeing that a lot. We just give our clients an opportunity to do whatever it is that they want. We talk about it. We give them options. If they want to do it, great. If you don't want to do it, then that's fine too.
Can somebody, what are the most amount of points a person could buy down?
Yeah, so it depends on who you go with. For the way we work is what mortgage company or lender you use. The way we look at it is we keep the loan. So you're paying the loan back to GMFS over the course of time. We'll let you do whatever it is that you want. I can tell you that there does become a point where it doesn't make sense.
Mm-hmm.
So I tell my folks, really after about 1.5 or 2 percentage points, it doesn't make sense because it's financially too costly. So let's say a $200,000 loan and you were going to pay, $4,000 to save $150 a month. You better keep that house for a long amount of time to hit your break even point, right?
Mm-hmm.
So it does get to that point.
If there was no equity going up in the house.
If there was no equity going up, but more importantly, most statistically, it shows that every 5 to 7 years, somebody's doing something, right? They're either refinancing, they're either going from a 30 to a 10 or 30 to a 15 or 30 to a 20, selling, upside, downside, somebody may have lost a job. So if you refinance or you sell within that timeline, that money that you spent's gone. So you left that money on the table. Not to say that, hey, I'm going to leave my house in 5 to 7 years, but statistics show you're either going to refinance, you're going to go to a different term or something like that. So that's the point of there is a point to where it just doesn't make sense financially to spend that kind of money. 1% is kind of the good general rule of thumb because that's going to save you about 0.5% in interest. And I like that play. I really like that play.
Does it matter if your loan is a fixed rate or a variable rate if you're doing that?
It doesn't. It doesn't.
Okay.
It doesn't.
Interesting. Somebody put that in there, so I thought I'd throw that in there too. Yeah. I was like, let me ask that. So it sounded like a real official. Ashley has a question. It says, do y'all have any information about loans for professionals like doctors, lawyers, etc.? I hear they allow you to put down 0% down. There's a loan package for just about any career. And, they have it now, is it the first responders loans? Every state's going to have their different loan packages. You just have to meet with a loan provider in your area that knows what those are, because not everybody does. Not everybody does.
But yes, to answer that question, yes, there's definitely opportunities there for that type of profession. There's even, folks ask me sometimes too, hey, look, I was on my job, or excuse me, I wasn't on my job. I'm just starting my job, but I graduated in nursing. But I graduated, a couple months ago, and I just started. Could I buy a house? Yes, absolutely. You graduated, you're going to work in the profession that you're in. I've used contracts before for doctors. Hey, look, I was in med school over the last 5, 6, 7 years. I got a contract with Women's Hospital. I'm going to work there. We use the contract and rock and roll. So there's a ton of products that are out there. And again, going back to having somebody that's knowledgeable in the field to make sure that they put the best product, available for you is very important.
People were really interested in that FHA zero down. They were talking about it at the last stream. I was like, let me get Ryan on, because I'm not gonna talk about anything I don't know anything about. I can tell you all about the house. I can't tell you about the mortgages. I don't work with those all the time. So if anybody has any questions, make sure you put it in the chat. And I don't know if anybody else knows this, that I'm also on podcasting now. So if you guys wanted to listen to this as a replay, don't forget, you can always, wherever you find your local podcast, I'm there too. So go ahead and check it out there. We have another question that came in. It says, what is a reasonable expected home value equity over the next 5 to 10 years? And how long is recommended to cover your property before selling? What to be like a 3% or higher per year is like 3% to me. Equity gain is normal, right? I would say that's normal and healthy. And anything over that is a bonus. So what do you say?
Yeah, I think if you do your numbers and you look at that, you're super safe there. I'm not. If I look back over the last 10 years, it's been just nuts, crazy, way past that. But every single first-time home buyer I sit down with, when I do the buy versus rent calculator, I show them that 3% appreciation. And that's worked for as long as I've been doing this. Obviously, in that first year, if you got into a jam and had to sell, you might be a little bit in the red by the time you factor in real estate commissions and stuff like that. But if you're anything more than 2 years on in, and it does, obviously depends on your down payment, of what you're doing and how much money you're putting down. But really, after that first year, you're on the positive side. And as I always say, unless you got a rich aunt or uncle, you got to pay to live somewhere. Figure it out, get with a good solid mortgage guy and a good real estate professional that will sit down and show you, here's the cost today, but here's the reality of where you're going to be in 3 to 5 years. And if you do that, leave the emotion to the side, you're going to be super excited about it. I know you've talked about it, Kristina. I see it here in Baton Rouge and surrounding areas, the cost of rent. It's super high. It's super high. And really, when you crunch your numbers, it's tax season right now, right? I know a lot of people get tax refunds back. You can use that down payment to catapult you to do something and build generational wealth for you and your family. So if you get a $7,000 tax return refund back, you can buy it. That's 3% on a $220,000 house. You got your down payment right there. People it still amazes me the amount of folks that I talk to. They're like, I didn't even think about that. What else are you going to go do with it? Well, I don't know. I might pay off some debt. I want you to pay off your debt. But if we could figure out a way to get you in a place and stop renting and wasting that $1,000, $1,200, $1,800 a month in rent, and you can do what we just talked about, you're in a much better financial picture. So those are all things that we try to go through. I know it's a big hot topic, right now is, okay, it's beginning of the year. What's my goal for 2023? Maybe it's to become a homeowner. Give me a call, or I'd be happy to just have a conversation with you to talk about what that would look like. I've done it thousands and thousands of times, sitting down with somebody. And that's really what's most exciting to me.
Even Eddie and I.
Add value.
Yeah, and even my mom and dad. Yeah, look, so the poll numbers are in. It says, will housing prices continue to go up this quarter? And the majority says they will remain flat for this quarter. And then the other 34% said, yes, unfortunately. 20% said, no way, they're going down here. And then I put in there, it's going to collapse ethically. And only 8% said it's going to collapse ethically. I still think it's like for the least expensive. This is my thought process, because first-time home buyers are the ones that are really driving the market, right? They're going to be the ones that are pushing the market. And since we do not have a lot of homes that are in that affordable range, that's where I kind of freak out. Like, our prices in those most affordable housing going to go up even higher, because those are the people that are going to be driving the market.
I'll speak. I think it's 30. Don't quote me on this, but somewhere between 28 to 35% is the numbers that I always see of first-time home buyers, right?
Mm-hmm.
So I think it depends on the market. I feel while they're not as low as what I would like them to be, I still think that they are affordable in our market, at least, right?
On our market, but for a lot of markets,
part,
it's
not the case.
Mm-hmm.
So I think it could definitely hurt, but I think you're going to see too, like when things slow down. Let's just use the mortgage industry. When the mortgage industry slowed down, there was a lot more products that came available. Okay, the last 3 to 5 years, it was like 4 programs. That was it. The rates go up, programs start coming out. Bank statement programs, down payment assistance is back. So there's always an offset of things that come out to where, again, for most folks, when rates were low, we didn't have a 2-1 buy down. We did not have that. What does that 2-1 buy down allow you to do? That 2-1 buy down allows you on a $480,000 loan we talked about earlier to get a $600 a month lower payment. So yes, I paid more, but I got a lower rate in order to offset the payment. So, it's a concern. Is it a fear, afraid, freak out? No. But it's somehow, and again, after the last 20 something years now, they always come out with something to offset that. In the 90s, I wasn't in the business yet, but from 99 all the way up to the time I started in the business, rates were much higher than where I was today. Well, prices were lower. Okay, but it's relevant, right? I mean, prices were lower, but rates were double, and in some cases triple where they are today. So
got my first house for 7.5%. And everybody kept telling me what a great rate I got.
You got a great rate. You
did.
But
my house was only $135,000.
What's that same house today? What's that same house sell for today?
It's over $300,000.
Okay.
It's over $300,000. But at the height of the last housing boom, it was over $300,000. Then it went down to $189, but it never went back to $135. Never went back to $135.
Nope.
Never did. And that's what it's like. Everybody keeps saying, oh, we're going to see housing. Like, I shouldn't say everybody. I have haters that get into my comment section and they're like, you're so wrong. You're stupid. The home prices are going to be 50% less. They're going to be less than they were prior to the pandemic. You don't know what you're talking about. And I'm like, how? Like, right. How? Just because you wish it and you want it to happen, how is that going to happen? What's going to be the reason why that happens? Someone actually sent me an email and they were explaining to me all the companies that were having all these layoffs, and that's what was going to cause all the home prices to go down. And I was like, okay, thank you for the information. I can't see it that way. It doesn't make sense to me. But if you want to make more sense about the housing market and interest rates and everything, you can get a hold of Ryan right here in Louisiana. He works for GMFS Lending, and he has a YouTube channel that I've been telling him to post more stuff on.
Yeah. You're helping build my confidence.
Yes. Here he is. Look at him. Look at him. He isn't doing enough, though. I got to get on him more. Ryan does his stuff except for YouTube. We'll get him going. Yep. Here. Oh, look, there he is. Look at him. What a handsome devil. And wow. The best part about Ryan is that anytime you talk to him on the phone, you feel like you're talking to a celebrity because he sounds like Mr. All right. Matthew McConaughey. And he's from Texas. How did you guys end up sounding the same?
Yeah, you blow my head up today.
Yeah, there it is. Ryan's channel right there. One quick question before we go. It says, does Ryan help investors in his area? Yes, he does. He's helped the Smallhorns. He's helped the Smallhorns quite a bit.
There's a lot of great stuff out there too for investors. I didn't mention this, but there are a lot of programs that came out over the last over the last year. So we help investors not just here in Louisiana, but all across the country. And a lot of investors love to buy in Louisiana, obviously, because the cap rate, they think our cap rate is just so amazing based upon the costs and stuff, and they can really make their numbers work. So I'd be happy to have a conversation with anybody. It's been really fun to see, this last, I guess, 6 months, whether you like it or not. The market always goes up. What goes up's got to come back down. And we've seen that.
Go?
I mean, we've seen stuff go from, like I said, a year ago, 3.6. Now we're, to 7.5, mid sevens, and now we're back to upper fives. Mm-hmm. I do believe that we settle out in that low to mid fives this year. And I think you're going to see it kind of a flat market. And we'll see where we take it. Lord knows I've been wrong on predictions in the past, so I don't really predict that. But here's what I know. People buy houses when the rates are up. They buy it when it's down. They buy it in good markets and bad markets. And no matter how you cut it, if you look back at wealth, and I'm talking about true wealth, yes, you got to have money in the stock market. Yes, you got to be diversified, this, that, and the other. But the most wealth throughout the entire country is built in real estate. Like it or not, that's what it is.
That's why I want more people to understand that, these corporate investors buying up neighborhoods isn't necessarily the best thing in the world for the country. And that's going to be in my video on Tuesday, so you can get my opinion about that. But if you need a real estate agent in your area and you're having a hard time, I'm actually connected with thousands of real estate agents throughout the country. You can just go to my website at KristinaSmallhorn.com, click on any of the pink links, and fill out a form, and I will contact you. If you leave your phone number, I will give you a personal phone call so we can talk about your real estate needs, and I can connect you with one of my friends. I have lots of friends around the country, so I'll be excited to talk to you. I've had some wonderful conversations with the people that watch this channel and listen to the podcast. It's always so much fun to hear their stories and be able to help them out, just like you do, Ryan, every week.
Absolutely. Well, you have helped me out, you and Eddie. I know we laugh about it and joke about it, but it's the truth. Some of the first properties that we were ever able to purchase was because of your help, and I'm super grateful for that. And really just enlighten me to there is another, until you do something, it's like the 4-minute mile. Until somebody ran the 4-minute mile, you just like, okay, maybe that sounds right, but try it. And getting into that real estate space was one of the best things that we were able to do. But I'm super thankful for you guys for helping with that.
Yay. Thank you, everybody. Thank you, everybody. I hope everybody has a fantastic week. If there's something specific in the real estate market that you want me to discuss in the next podcast, make sure that after the stream is done, you put it in the comments section and I'll look it over. And if anything looks really super interesting, I love to talk. So we'll come up with something new. And he's going to be putting something on the screen. Oh, look. And Eddie said, if you want to go to the podcast and subscribe to any of them, we're all over the place. We're on Spotify. We're on iHeartRadio. We're on Apple's podcast. So, just go over there, give it a listen, give it a comment. I've gotten a couple comments, which is really nice. So if you could share that out with your friends and family, I would appreciate it. And so would Ryan. So
absolutely.
Thank you, everybody. Have a wonderful week.
Thanks, guys. We'll see you soon.
You always have the best information. I won't talk numbers. I wish